Friends, I welcome you all to our today's session on orientation program. And today's topic is Interfirm and Intrafirm comparison. Okay, let us understand some of the concepts which are involved in these two types of comparisons. A small disclaimer before I start that your classes are being recorded. That is one thing. I think you are quite aware of that thing. And in this particular session, I'll be using the PPTs which are developed by the Institute of Chartered Accountants of India. So they are not my own PPTs. And these PPTs will be containing some views or maybe some opinions or some content of academic interest. They're designed in such a way that it will facilitate the training process of prospective chartered accountants. But the views or content, it is not necessary that those views or content are subscribed by the institute nor by the faculty. Okay, so that you have to keep it in mind. So this is only developed for academic purposes, for training purposes. And wherever I felt necessary, I might have modified those PowerPoint presentations for the convenience of teaching. Right. So with that background, let us start our today's session. Interfirm and intrafirm comparison. From the name itself, you must have understood what we are talking about. We are talking about some kind of comparisons. Okay, various kinds of comparisons. And since your childhood, I think it must have been taught to you that comparison is a good thing or bad thing.
Good thing.
Okay. Some of you may say good thing, may say bad thing, right?
Bad thing.
Okay, maybe that opinion will differ whether it's a good thing or bad thing. Let us see in our context, in the context of our profession, how it is relevant. And yeah, maybe for the knowingly or unknowingly, many times we do comparisons. Okay, let us say many times, specifically if you see the students of chartered accountants, when the results come, definitely they compare with the results of their friends. Is it not? They say, okay, somebody has passed, somebody has failed. What is the reason? That is one kind of comparison. So in that comparison, what exactly happened? They compare themselves with some other person. And many times we have seen it has got some, you see, positive element also. Suppose someone has passed just by securing 200 rupees and another person who has passed, who has failed by securing 195. So definitely it gives a lesson, okay, I am up to this. I'm capable of securing 195. Only 5 marks extra I need to pass the examination. And my friends have already passed for secured 200 marks. Okay, then they may try to identify, okay, let me see what is the paper in which I could have earned 5 marks extra. So that is a kind of healthy comparison. You can say this gives us a kind of assessment, self-assessment, that what one can do. Is it not? So you are comparing, or a student is comparing himself with some other person. Sometimes students also perform himself with themselves. Okay, how he try to compare himself. Let us say last attempt, November attempt, he has done something, May attempt, something else has happened. So one can definitely compare over the period of 6 months, what is the improvement, where he lacks. Okay, or it can find out where marks has been reduced. Is it not? That has also got some positive impact. So one can easily find out that what is the paper in which he needs to focus. Yes or no? So if you think from right perspective, you can find out the comparison can many times be helpful. Okay, unless we observe the negative issues involved in comparison, which creates a lot of stress and all. So if you are able to avoid that thing, then definitely it's a very positive thing. And friends, in corporate world, when you're talking about this similar kind of comparison do exist. Okay, we give a different name as interfirm comparison and intrafirm comparison. Okay, when you talk about interfirm comparison, you must be knowing that what exactly I'm talking about. What kind of comparison I'm talking about? This interfirm comparison. What is this? Can you interfarming?
Interfirm.
Interfarm means comparing yourself with a similar farm.
Yes, sir.
With a similar farm. That is important. Isn't it? Suppose you are a construction company, you are supposed to compare your performance with the construction company's performance. Isn't it? So you are a construction company. If you compare yourself with a pharmaceutical company or a banking company, you may not get good result, or the result may not be useful to you. Yes or no? So when you do something, you have got a farm, we are comparing it with different farms and comparing it with the industry, you can definitely call it as interfarm comparison. Okay. And when you coming to intrafarm, what exactly I mean intrafarm comparison?
Comparing with oneself
between different departments of a company.
Yeah. So you are comparing with different departments of the. Okay. Maybe you are also comparing your earlier period results or earlier period performances. That's also interfarm comparison. Sorry, intrafarm comparison. Okay. Suppose last year's results can be compared with current year's results of the same farm. That's in intrafarm comparison. Is it? Or two divisions performance can also be compared. Okay, particular two divisions. So two products are manufactured. Okay, so same company, let us say producing tube lights, it's also producing CFL bulbs. So I can compare the tube light department with CFL bulb department of the same company. I'll be calling it as intrafarm comparison. Again, quarterly results also can be compared. Q1 results with Q2, Q3 results, that also you can compare. Okay, or corresponding quarterly results also it can be compared. Last year's Q3 result with this year's Q3. Third quarter, what was the sales in the previous year, and what is the sales of quarter 3 in current? That comparisons are possible, is it not? So these are all examples of intra-firm comparison, and there is a need to do so that one can find out the strengths and weaknesses. Okay, so now let us discuss some more issues. Let us first understand what is that. I gave a brief introduction about the thing, about these two concepts. So let us first understand what exactly happens here and what is the technique involved, what are the objectives, and how one will be able to identify the strengths, weaknesses through this process. We'll be learning all of them. So I'm going to share a screen with you right now. Okay, so I think you have understood this picture, what I exactly mean. Can you say what this picture suggests? Can anyone interpret this picture?
Both the companies have different working structure.
They are
and
different
product also.
companies, but they should be of similar nature. Point here is that apple should be compared with an apple. Apple should not be compared with an orange.
Yes.
Okay, of course, farms are different. They're different, but they should be of similar type, or they may belong to similar industry. Okay, before I start here, many times people get confused with this concept. When I say that we're talking about interfirm comparison. Now, what do you think? Where from I will be getting these figures for comparison? How can I compare? I need some data. Yes or no? How can one compare? I need some financial data. So can you tell me where from one can get this data? Where this comparative data will be available?
Annual report.
Okay, so that is what first thing coming to your mind, that annual report, which is publicly available. So think is that if things are publicly available, you may not get the things in detail. Right. Suppose in financial statement, what you will be able to get? Okay, you'll be getting your revenue, you'll be getting your operating expenditure, you'll be getting your non-operating expenditure, you'll be getting depreciation, you'll be profit after tax. Is it done? All these things one will get from annual report or from a published financial statement. Yes or no?
Yes, sir.
Yes, yes. One can get the capital structure also. What is debt? What is equity? What is the size of current asset? What is the size of non-current asset? One can get all of this information. But can you get the, let us say, cost structure from annual report? Can you get a cost sheet, product cost? May not be. Okay. Can you, with the data available with the financial statement, will you be able to compute the break-even point? May not be. Okay, so some data is available. So there is a limitation of using the data which is available with the annual reports, or you can say publicly available documents like financial statements and other things. Right. So now let us see what is the technique there, how one can collect data so that one can do effective interfirm comparison. Right. So let me show you the screen again. Yeah, the first thing one have already concluded that if you want to do this comparison, we should ensure that we are comparing apple with another apple. Similar kind of farm has to be compared. Right. So this, when I say interfirm comparison, what I'm referring to is a technique of evaluating the performance efficiency, cost, and profit of firms in an industry. So here, friends, we are talking about within the industry, there might be several firms. Can you give me example of some firms in a particular industry? This is again a question I'm throwing at you. Suppose we are talking about the banking industry. Can you tell me the examples of some firms in banking industry? Let us say how many of you are aware of this thing. In fact, indirectly, what I'm asking, give me the name of some banks.
SBI, SDFC,
Okay.
Kotak, sir.
Central Bank,
Bank of Baroda.
Okay.
South Indian.
IDFC First Bank.
Fantastic. Okay.
South Indian Bank, sir.
Right. So you gave me, you see, in a particular industry, you gave me some examples of some firms. You can definitely compare among them, compare their results. Or you can also, in the industry, you can create some groups. Let us say, within that banking industry,
private and national.
broadly, you can find out public sector banks and private banks. Okay. In order to make the comparison more effective, you can do one thing. A public sector bank needs to be compared with public sector bank. Private sector bank needs to be compared with private sector. Okay. You can also compare it with other public sector firm. That's also there. Suppose you are leading a private sector bank, then you want to do an interfirm comparison. You are the CFO. What you would like to do? First, definitely you would like to do compare yourself with other private sector banks. Then you can move to public sector banks. Okay, if you directly compare it with the public sector banks, then your results may not be very useful. Are you getting? First, we need to compare with our peers, then we can go beyond that. Similarly, let us say I'm asking you some more thing. Let us say, can you give me some examples of firms who are there in pharmaceutical industry? Okay, banking industry is a very simple question. Let us see.
Biocon.
Okay,
Dr. Reddy.
So very good, very good. So that gives me a confidence that you are aware of the market. Yeah. So now you see, now you have understood when you are doing interfirm comparison, that we can definitely collect some data from the publicly available financial information and do a comparison. That is number one. And is there any way or what one should do for the benefit of the entire industry? Can we do some kind of comparison or can we do some kind of research by following a technique? so that the result of the analysis will be useful. How it is possible? If all the firms join together, if they form a common forum, let us say they form a kind of association kind of thing, then it is possible to collect data, internal data, maybe their cost accounting information can be collected and results can be analyzed. That possibilities are there. So now, friends, what I was talking you right now, then first of all, if you try to understand what is interfirm comparison, it's a technique for evaluating performance efficiency, costs, and the profit of the firms in an industry. This concept we have understood. Now, second point, if you see, it consists of voluntary exchange of information and data. So what is expected? That the firms who are a part of the industry, they should be voluntarily exchanging the information and data. If they share the data and information, then only it can be used purposefully. Okay, they must be engaged in similar type of operation. So one can easily compare. Okay, let us say from the let's say from a financial statement also, one can compare the gross profit of different companies within the industry. So normally the gross profit ratio should be more or less same. So one should have a similar type of gross profit ratio. If a particular firm has a different type of gross profit ratio, one need to investigate what is the reason for that. But when we are comparing the internal data, let us say cost sheet you are comparing. Friends, you see, financial statements are more or less standardized. You know how revenue is recognized, how expenses are recognized, how closing stock is recognized in accounting. So consequently, gross profit that you calculate is standardized. But when you compare a cost accounting rate, or let us say how cost sheet is prepared, it is not that standardized. To a large extent, it is standardized. Of course, okay, so companies are also expected to follow the cost accounting standards. To a large extent, it is standardized, but still there is option to follow different methods. Okay, suppose I will compare the cost sheet of, let us say, Coca-Cola with Pepsi. Unless they follow this, normally I feel the costing should be same. But if they adopt different methods of costing, then comparison may become meaningless. Is it not? Let us say someone is doing costing on activity-based costing, someone is some other time costing they are following. So the way they allocate the direct expenses and the way they absorb the indirect expenses will be different, may be different from different companies. Yes or no? So if that is different, that means if the costing methods are not same or similar, then it is difficult to get a meaningful result from the comparison. So that one is expected to be careful of. Okay, are you getting me? Yeah, so that is what I'm saying in the third point. If you see here, that such comparison will be possible where uniform costing is in operation. When all the firms follow a uniform costing method, then okay, comparison will be more meaningful. Okay. Now, if you look into the benefits of the use of the preparation of this kind of comparative statements of making a interfirm comparison, you can find out they may be useful on these grounds. So by doing that kind of comparison, one can find out how is your unit performing in comparison to that of others. How you can know performance? You can know performance by seeing the gross profit margin, by seeing the net profit margin, by seeing the profit after tax. Is it not? So through all these things, the financial statement one can do comparison. From costing records, one important thing, I think all of you have studied a little bit of costing. Yes or no? So one can compare, let us say, contribution. What is the contribution? That can be compared. Normally, it should be similar. If your method costing is same, then contribution should be same. So contribution per unit of Coca-Cola bottle should be same. More or less, it should be same contribution per unit of Pepsi bottle. If they're following the similar method of costing, we feel. If it is not so, then we need to investigate what is the reason. Contribution you have understood. Sales minus variable cost per unit. Okay, but after that, discretionary expenditure may come. So in net profit, whether they can be compared or not, that's a different thing. But gross profit should be compared. Because net profit, I got discretion. How much salary I will pay this? I have to decide. Other company has to decide. Is it done? What will be the depreciation? Depends upon the age of the asset and all these things. That may vary. All other expenditures can vary. But my contribution should not substantially vary. Or my gross profit margin should not substantially vary. Is it done? So one can easily identify that where one lacks if he does this kind of comparison. Okay, friends, got it? So one can easily say whether our unit is performing in how the unit is performing in comparison to that of others. And are we operating as efficiently as we might? Others might be operating more efficiently, whether we are operating with that efficiency or not. Is there any areas of business improvement where one can easily find out where improvements are possible? If you find the normal loss of your unit is more than the normal loss of other firms in the same industry, you can find this area where improvements are possible. Or if you find your power consumption is more, you can also find out what is the reason where improvements are possible. Okay. And if we are successful, what are the strong points on which success depends? Suppose we as a firm, we feel that we are successful, we are ahead of others. Our revenue is good, profit margin is good, contribution is good. But what is our strong point? That also we need to know. Everything is good, that doesn't mean that I should not compare. Okay, you have done wonderful in the exams. Okay, and you cleared one group. But that doesn't mean that you did not compare. If you compare, you can find out, okay, what is your strong point? Suppose you have found out this is my strong point. Audit is my strong point. So maybe in the next level, and the final, you can say, okay, this is my strong point. I always do good in this particular paper. So I can secure more marks so that in some paper, even if I secure less marks, that can be averaged out. So one will be able to recognize its strengths through this comparison process. Or if you compare with others, you see everybody has secured in the range of 40 to 50, but I have gone to the range of 50 to 60. Okay, so that is my strength. One can easily find it out. Okay, so this is, you can say, one more advantage of doing comparison. And with this process, one will also be able to increase efficiency as well as profitability. Efficiency can be improved. You can find out your weaknesses, you can find out your strong points. And if you take suitable steps, then profitability will be improved. Okay, friends, understood these points?
Yes, sir.
Yes, sir.
Okay. So this process, when you talk about the interfirm comparison, it has got certain objective. Okay. This indicates, interfirm comparison indicates the efficiency of production, selling, adequacy of profit, weak points. All these things can be identified. Okay. It also may enable the management to take some suitable steps. And it will also may be used as a motivating item. So it may motivate the organization to adopt the best industry practices. So these are the, you can say, positive results. If comparison is done positively, one can easily get. Now you see, if you look at this picture tries to explain to us how one can collect data and what is the process through which this comparison is possible. As you can observe, it is called the requisites of interfirm comparison. If you want to compare yourself, suppose you want to compare your marks with your friend's mark. First thing which is necessary is that your friend should be ready to share his marks with you. Otherwise, how can you compare? So here what is required when you're planning to do interfirm comparison. There should be a center for interfirm comparison. That means some entity, some center, or some association needs to be formed. Then there should be members. That means the members of the industry, that means other firms who are members of the same industry, should be the member of this center. Then one has to decide that what is the nature of information that is to be collected. What will be collected? What are the data we require? Let us say we need turnover data, gross profit data, all this. And how it will be collected and how it will be presented for user purpose. Okay. So this is what we have to see. That means a common center is necessary, membership is necessary. Okay, then one need to decide in which form data has to be collected, then how it is to be presented. Now let us decide. Let us say you are in an industry. Then what you can do? And you feel that comparative data, analysis of data is necessary. Okay. So one thing may happen, then you may first of all form an association of industries, association of the firms, where the members, these firms can become members. Up to this, it is okay. The next challenge comes that you will be asking them for inputs. So here there is a possibility that you may face some challenges because people may not be ready to share their data. Okay, suppose you are asking them, what is your, tell me what is your sales, what is your purchase, what is your gross profit? Okay, what is your direct cost, what is your indirect cost, what is your break-even point? Okay, what are your leverages? If you ask them, whether people will be ready. Yes or no? Unmute and talk. Friends, please participate. Unmute and talk.
No, sir.
May not
They will not be ready if they are
Not sure.
may not be ready because some of them may feel that my confidential information may be leaked. Therefore, practically what happens many times, they are asked not to share absolute data. Absolute data means absolute numbers you need not share. You need not tell me what is your sales, but let us say you may share in some ratio form. So you may share with your GP, share your gross profit ratio. You may share with me some turnover ratios or data turnover ratio, so that these ratios can be compared. So no one is sharing the absolute data, but they're sharing the ratios. Sometimes absolute data may be necessary. Suppose you want to project, suppose as an association of the industry, you want to show to the government that you see this industry is suffering because of this thing. Then you need data for that. You need, this is the sales price at which we are selling, this is the cost. And if you want to show to the government that we are incurring losses because of this thing, so then you need actual data. And that's possible only when you collect the data in absolute terms. But otherwise, if you need it for some other purpose, some analysis purpose, just to make a simple, we want to find out what is the average GP ratio of the industry. then data may be collected in ratio component. It need not be collected in absolute numbers. Okay, friends. Now, so this is the process in which one can do. There should be a center. There should be membership. One need to decide what are the information to be collected and what is the method of collection. Okay, either they will be submitting some reports or you'll be submitting some questionnaires, or periodically some data may be uploaded in some drive. Then automatically that can be summarized. Okay, so first step is that the center form interfirm comparison needs to be established. This is the central body, and it's necessary to have this kind of. What that body will be doing? Body will be collecting data and information from its members. Okay, some data. Let us say we all chartered accountants can have a similar kind of association. So many data can be collected. For example, how many tax audits one is having. So one can easily find out if the data is collected, then one can easily find out there are some firms where more tax audits are there, some firms there are less tax audits are there. So one can take a positive decision how to distribute it. In maybe in some particular area, some firms might be overloaded with one, and some firms might not be having enough one. So for the benefit of the industry, one might take a decision how to, let us say, distribute the work uniformly. These possibilities are. So this center will be collecting the data. It will disseminate the results to its members. It will be sharing the results with the members. And it should be undertaking research and development work, which is necessary for the common benefit of each member. And in addition to that, the center may be entrusted with the responsibility of conducting training programs and publishing magazines, etc., where the data can be easily described and disseminated. Okay. Understood what is the role of this center? And thereafter, one can think of a membership, how members can be taken in that association. Okay. Different forms of needs to be involved. More the better. If all the parts of the industry can be, if they can come together, then nothing like that's the best thing. Then one need to decide what is the nature of information to be collected. So this is an indicative list you can see on your screen, that which type of information can be collected for an interfirm or intrafirm. This is, we're talking about interfirm comparison. Right, like information regarding cost and cost structure. What is the cost? Suppose we are talking about the manufacturing firm. So what is the cost of material? That data can be collected. Okay, suppose we are producing some plastic bottle. What is the cost of plastic or plastic powder that is to be used? Which firm is purchasing at what cost? That analysis is also necessary. And what is the cost structure? What is the component of your, let us say, fixed cost, variable cost, direct cost, indirect cost? So that component wise one can analyze. And then one can easily decide how, by doing some changes, one will be able to maximize its profit. Okay. Got it? Yes or no?
Yes, sir.
Okay.
Yes, sir.
Right. Then one is cost and cost structure. Then raw material consumption. One can find out the ratio. One can simply find out the input-output ratio. How much is the input of raw material and what is the output? Okay, if farm A with this much of output, this is the raw material. Farm B should be having for different amount of output. What should be the raw material? One can easily find it out. And if more raw material is consumed, that means there is some wastage. Yes or no? So raw material consumption will give you some better data. Okay, suppose you are computing steel industry. For this much of iron ore, this much of output is produced. Other farm is so much of output. What should be the raw material? What should be the raw material quantity? One can find it out. If quantity is more raw material is consumed. That means maybe quality of your material is poor. Or there is wastage. Okay, or there is something is required with respect to technology. Some reasons is there. Is it not? So by comparing this input-output ratio, one can decide where something is going wrong. So one will be able to find out one's weakness. Okay. Similarly, if you compare the stock position, if you keep your stock, if you keep high stock, suppose raw material is stored, storage has got a cost. Is it not? There's a possibility of loss due to theft, maybe deterioration. It has got a carrying cost. So more raw material you're storing means you're incurring more cost. What is the average quantity of stock different farms are keeping? One can find it. Suppose farm A is keeping 2 months stock and farm B is keeping 3 months stock. And we are seeing the farm A is keeping 2 months stock and managing comfortably. That means the storage cost, carrying cost is paying for only 2 months stock. And another farm is paying for 3 months. So cost is increasing. So this type of weaknesses one can find out by analyzing the cost structure. Are you getting? Same also wastages. So there is a normal wastage. Normal wastage according to industry terms, how much is acceptable one should decide. Suppose industry norm says in this type of industry, 2% of normal wastage is acceptable. Okay, if it is beyond that, that is abnormal. That should not affect your pricing decision. Okay, there is something exceptional. You need to find out exact reason. And you need to fix accountability for that because that's abnormal. Is it not? Okay, your cost is maybe more because of this kind of abnormal losses. But that should not affect your pricing. Just because your cost is more, you should not increase your price. Rather, you should focus how to avoid that abnormal loss. But to take the decision that what is normal loss, then only you can know what is abnormal loss. So loss beyond normal is abnormal. Is it not? If you are producing something and you know with 100 kilo of raw material, 95 kilo of finished goods can be produced. Let us say that is the normal. With 100 kilo of wheat, 95 kilo of wheat flour can be produced. So you may think, okay, 5 kilo is or 5% is a normal loss. If some entity or some farm, the loss is 6%, that means 1% is abnormal. Okay, 1% is up. And you should not make your pricing decision on the basis of that. So you have to assume that what is the cost of this 95 kilo, or let us say, you have to decide your selling price on the basis of cost of this 95 kilo. because 1 kilo extra loss is your abnormal loss. You need to find out what is the reason for that. You have to fix accountability for that. Who is the person responsible? Understood? Okay. If you have any query, you may feel free to ask me. So, information may be needed with respect to cost structure, raw material consumption, stock, wastages, labor efficiency, and utilization. That means labor utilization, as well as machine utilization and efficiency. This is one more area. For this much of production, how much should be the labor cost? If labor cost is more, when you're doing this interfirm comparison, there is every possibility that labor may not be utilized efficiently. So one need to focus in that area, how to maximize the utilization of labor, or how they can be more efficiently utilized. Similarly, it will also give us some idea that if some particular area, some particular aspect of production or other facilities can be automated, or machines can be used, it will reduce the cost also. So labor utilization and machine utilization, they can be compared. One can compare farm-wise what are the activities for which machine is utilized and what are the activities for which labor is utilized. One can also find out what are the farms who are using machines and earning more profit, or there might be farms which are not using machines but still earning more. Okay. So this is one more area, labor utilization and machine utilization. With in that area, data can be compared. Then capital employed. How much of capital is employed? What is the size of capital? Or what's the net worth of farms? On that area also meaningful comparison can be done. Because capital structure may affect profitability. Okay, farm might be producing goods and services, might be earning operating profit. That possibilities are there. But if you look at the farm's capital structure, you may find out that capital structure is not all equity. There is a debt. Debt is used as a capital. Since debt is used, there is an interest component in the cost, non-operating cost. Okay, it's a financing cost. So there is a possibility that even if farm is having good operating profit, or operating profit is par with the industry. Industry operating profit is 40%. This farm's operating profit is also 40%. But because of this financing cost, the farm has taken a loan and is paying interest. Net profit is, let us say, negative. We're taking an example. That means there is nothing wrong in the production. There is something wrong with the capital structure. If the capital structure can be improved, let us say that debt, if that can be converted into equity, then farm will earn. Is it done? So this kind of problems can be identified. Okay, as future professionals, you should be able to identify this thing. What is the problem with this farm? Just like a doctor identifies where exactly the problem lies. If the farm's financial health is not good, what is the reason? Reason is the profit is not good. Okay, profit is not good, but why? Is it because of wastage? Is it because farm is unnecessarily keeping a huge stock? Is it because there is something wrong in the capital structure? Okay, when I say we'll be making interfirm comparison, that doesn't mean that we'll be comparing the figure and finding out the trend. No, it's not like that. We'll be trying to find out the solution for it. So each figure needs to analyze technically. Okay, So in this, in our discussion also, you might have identified or might have understood there are some areas which are critical. Okay, like GP ratio comparison is critical. Wastage analysis is critical. Utilization of labor analysis is also critical. Okay, and your capital structure of the firm, that is also critical. That affects your profitability. Okay, now please. I told you this, labor employed and return on capital. Okay, or return on investment, ROI. That comparison can also be made. And comparison can also be made with respect to liquidity of the organization. That means how much is the current asset which can be liquidated at any point of time, which can be quickly converted into money. That's also useful analysis for the purpose of identifying the strength areas. The reserves and appropriation of profit. Comparison can also be made in that area. Reserves and appropriation of profit. So because of creation of reserve, because of appropriations, your net profit might be low. And these are subjective things. Suppose you got debtors, but how much bad debt you will provide? It is subjective. It requires a kind of estimation. Management may estimate that I will provide 10% as my bad debt. Somebody may say not 10%, 15%. So because of these variations, profitability will be different. Okay, our one can easily find out what is the industry standard of making bad debt. If industry standard is 10% and my firm is making 15%, either I'm overestimating the bad debt or there is something wrong with my quality of debtors. My sales team may not be able to make quality sales. That's why my debtor is becoming bad. My percentage of bad debt is, one can find out what. So connected point relating to this is that comparison of debtor and creditor positions. Okay, they represent my current asset and current liabilities. So if this is my sales, let us say my sales is 1 lakh rupees for an example. What should be my debtor? So for 1 lakh sales, if industry standard is 80% cash, 20% credit, that means sundry debtor amount in the balance sheet should be around 20,000. If it is more than that, then I am taking a risk. And maybe that is why I am having more bad debt. Okay. Same also. Comparison of creditors. Okay, suppose this is my purchase. My purchase is 1 lakh. I'm seeing, I'm making an interfirm comparison. I'm finding out that 50% can be purchased through credit. So firms are purchasing 50% of their purchases through credit. Okay. And I'm comparing my firm. Only I have got creditor, I got only 20%. That means I need more money to pay my creditors. Whatever I have to purchase, I have to purchase more in cash. I do not have more creditors, is it not? That means what? That means I need more working capital. I need to keep more money in my pocket because creditors are not giving me my credit. Or I might not be, one thing is that I may be underutilizing my credit capability. I can take credit, I am not utilizing. Okay, maybe I'm not aware of that more things can be purchased and credited. So in the process, what is happening? I am requiring more capital, more funds are required, more cash I have to keep. That money could have been utilized in some other area and could have earned some return. Okay, so each item, if you see it, if you minutely observe, you can find out what is the difference. If you make this interfirm comparison, where your farm is like. Okay, friends, if you start doing, you'll find it is quite interesting because you have to analyze the thing. You have to think what is the consequences. What are the consequences of this thing? Okay, so an interfirm comparison of creditors and debtors may not be in absolute terms, but in terms of ratio. What is the debtor size in relation to sales? What is the creditor size in relation to purchase? Okay, and you can also find out what is the gap between debtor and how much money I have to receive, how much money I have to pay. That gives me a cushion, that gives me a comfort level. Okay, I have to pay this much, but how much I have to receive? That gives you a comfort level if you analyze that. That also can be compared industry-wise. In fact, what we are comparing here, the net current assets. That means excess of current assets over current liabilities. Okay. In order to understand the business, in order to understand the finance of the business, then you have to make this type of analysis. Okay. Right. Okay. Now, next area is that, yeah, creditors and debtors. The methods of production and technical aspects. That is important. That what method we are following to produce something. Okay, let us say you are producing steel, you are producing aluminum. There might be various methods, various technologies which can be utilized. So which technology gives more results? One need to identify. That's possible if you can make interfirm comparison. You may think of changing your technology. Okay, you may think, okay, I'm producing steel by using German technology. My GP margin is this much. And you see my sister's concern, or my, let us say, my competitor. Okay, he is producing, let us say, by using a Russian technology or Chinese technology. And their GP margin is more. So one can understand, okay, next time whenever I will do expansion, I will not use this technology. I may go for some other technology. So technology comparison is also important. Okay, friends. Did you understand all these points I said now? Like comparison with respect to cost and cost structure.
Yes, sir.
If you have any query,
Yes, sir.
okay, in case you have any query, you may freely ask. So comparison in the area of cost structure, raw material consumption, stock, wastage, labor efficiency, labor utilization, machine utilization, capital employed, return on capital, liquidity, reserves after patience, creditors, debtors, and methods of production and technological aspects. So comparison can be made in all these areas. Any query you have as of now? No. Okay. Now when we have understood that this comparison is useful and we should do that thing to understand the business, to understand the industry, and also to find out the strengths, weaknesses, etc. Now we have to think how to collect data to make this comparison. Of course, initially you have told that some of this data can be collected from financial statements, which is publicly available, right? So listed companies data is already available, and unlisted companies data is also uploaded in the with the Ministry of Corporate Affairs. So one can get because they're public documents, one can get the data. But their limitation is that only some comparable data you can get. Like stock positions you can get, sales position you can get, purchase, sales, debtors, all these things you can get. But costing related information you cannot be able to get. Okay, you may think of some indirect way of calculating profit. Okay, maybe in some other their report, in the annual report, maybe in the board report, they might have disclosed something about this thing. So one can compare. Okay, but if you follow the other process, what we are discussing about, that form a central organization where information can be shared, then you can get the required data. Now let us discuss about the process of collecting data, how data can be collected. Various ways one can collect the data. One can develop a prescribed form kind of thing. Let's say periodically that form has to be filled up by the industry and be submitted. Sometimes we also feel that if you give a questionnaire, which will be containing some questions, then through that questionnaire also data can be collected. Data may be collected yearly basis or maybe periodically on quarterly, half yearly, like this, right? Depending upon the requirement. Normally, information is supplied in the form of ratios, not in absolute numbers, in order to make confidentiality. Right. Then information collected as above, what I told you right now, is stored and presented to its members in a particular form, or a report is made, analyzed. And since this has got a lot of importance, this analysis, and this is useful for improving efficiency, these are not normally made available to the non-members. So only a member can use this information and data will be made available to the members. This data is normally not made available to non-members. This is the process normally followed among various industries to make interfirm comparison. Okay, and this type of comparison has got many advantages. It will give us an overall view of the industry as a whole to its members. Members can get an overall view that what is the, let us say, turnover size of the industry. Okay, what is the, let us say, some ratios, what is the GP ratios, what is the net profit ratios, what kind of investment is required, what is the ideal capital structure. So this type of information can be collected. So this report identifies the strengths as well as weaknesses vis-a-vis others, because the results come from comparative analysis only. And this report also helps on unbiased specialized opinion. That means one can develop unbiased opinion on a particular problem so that solution can be thought of. Okay, suppose a particular problem is there. So you know, sales price, let us say, fixed, and purchase price also fixed. And there is a common problem that GP margin is very low. So this problem can be addressed by representing it to the government that the industry is suffering because of this. And if it continues in long run, industry may be finished. Okay, and it can be shown that this is the industry-wide phenomena, not that one farm, it's a case with only one farm. Entire industry was finding the similar kind of thing. So since that will become an unbiased report, the authorities may rely on and take suitable steps. And when this analysis is done, it develops a cost consciousness among members of the industry. Industry members become very conscious about their cost because they know that they are going to be compared, right? And if they are not comparable, then, or you can say if they got some weaknesses, then the members will try to overcome that. In this process, they become more cost conscious. They try to produce goods and services at a cost which is par with the industry. And this type of analysis also helps government for effective price regulations. Government also needs information that what should be price for some products. So this type of data helps them. It also helps to improve the quality of products because wastages can be reduced. One can find out what kind of material industry is using, what kind of material you are using. So it helps in improving the quality. It also reduces the cost of production. Therefore, this kind of analysis is very advantageous to the industry and to the society as well. Okay, friends. Okay. Now, friends, so far I was talking about interfirm comparison. Now let us come to intrafirm comparison. That means coming yourself with yourself. Interfirm comparison. It is something like analyzing your self-reflection. It is something like looking at the mirror. Okay, you may compare various departments or divisions of your own unit, or you may also compare with your past results. Okay, so now if you, meaning you have already understood, two or more departments or divisions can be compared with an objective of making meaningful analysis for the purpose of increasing the effectiveness and the efficiency of the departments or divisions. So if you compare two departments or units, okay, if they are producing similar kind of thing or maybe different kind of thing, they can be produced. Let us say for division 1, how much is their investment, how much profit they are giving. Okay, let's say two divisions are there in the garment industry. One is manufacturing trousers, another is manufacturing shirts. Let us say shirt unit, what is the investment, what is the profit? Trousers unit, what is the investment, what is the profit? So one can calculate the return on investment and one can decide which division is giving more profit. And if some division is giving less profit, that can be eliminated, that can be dropped out. Who knows, one particular unit might be making losses, but overall picture is profit. We have not identified which sector is making profit, which sector is making loss. So now you see, if you do this division-wise comparison, you need to have division-wise data. Okay, so that is the concept. These divisions can be considered as profit centers or revenue centers or cost centers for whom cost has to be incurred, and who are independently are supposed to generate their revenue, and they have to show themselves as a profit center. Okay, so if this kind of comparison is done, it will definitely 100% develop a kind of cost consciousness among the employees. It will improve the efficiency of the various divisions. Yes or no? Are you agreeing with me?
Yes, sir.
Yes, sir.
Okay, please. Okay. The next thing is that it also means the comparison of the results achieved by the organization over different financial periods. So last year results you can compare with this year's results. Last quarter results you can compare with the current quarter results, like this. The last year's a particular quarter results can be compared with the current year similar, or the same quarter's results can be compared. Okay, here firm's own performance is compared. Okay, so data availability becomes easier. Okay, so confidentiality can be retained. Now let us talk what are the various advantages of this kind of intra-firm comparison. First of all, it will be helping the organization to understand its own strengths and weaknesses. Okay, and how the organization have evolved over a period of time. One can understand through this. Let us say how sales is growing, how profit is growing over a period of time. One can do it. One can understand by referring to or by comparing earlier period results. Okay, and which division is doing good? One can find it out. Through that process, one can find out what are the strengths. Right. And this process or this concept of intra-firm comparison helps the organizations to develop and promote a profit center model. That means each department, each center should try to contribute something towards the profit. And their focus will be on profit. Okay, wherever it is possible, there might be some departments, some centers where objective is not to profit. That's a different thing. But wherever possible, this model helps converting these departments into profit centers. And ultimately, various departments' results are compared and overall results are arrived at. So one can easily find out which department is contributing most for the overall result of the entity. Right. Now, friends, intra-firm comparison also helps the top level management in identifying the problem areas with the organization, which may have been contributing to the declining performance over a period of time. So who knows? There might be some area which are problematic area, and these problems are contributing for the declining performance of the firm. Firm's performance is declining because of poor performance of these divisions. Okay. So one can identify, one need to identify those divisions so that if required, then this particular area of activity may be dropped. Okay. Now, this type of comparison will also help or will facilitate cost control decisions. If you want to bring a permanent reduction in the component's cost structure, then this kind of intra-firm comparisons is necessary. It will also help in arriving at the pricing decision, production planning, expenses planning, future investments. For doing all these things, in which area you should invest. Let's say there's a decision. You got some money, but you want to invest. But which area you need to invest? For that thing, you need to find out which division is contributing more and where there is a scope of more profitability. So you are supposed to invest in that area. Otherwise, the investment may not result some fruitful result. Okay, so for this kind of managerial decision, investment decision, production planning, price decision, cost control decision. These kind of analyses are necessary. Okay. Understood, friends? Did you understand up to this?
Yes, sir.
Well, friends, now having understood some basic things about this interfirm comparison and intrafirm comparison, I'm sure most of you are having some idea now that what are the things we need to compare and what is the usefulness of that comparison. Now we'll be talking about some of these limitations of these comparisons. Just a minute. Let me share this slide with you. Before limitation, let us see this advantages part. Okay. So in this process, we know when you do intrafirm comparison, one will be able to understand firm's own strength. And accordingly, one can develop and promote a profit center model and compare the ultimate results. One can identify the problem areas, and one can use this comparison for making cost control decision, pricing decision, production planning decision, expenses planning, future investments, all these things I was just telling you now. But this advantages has got, not this advantage, this process of comparison has got some limitations also. First of all, the top management may be a little reluctant or maybe uncooperative, sharing information of various departments. So that needs to be addressed. Then various departments of the organization may not be functioning with same logic or in same business environment. Let us say two departments which are located in different places or in different states, let us say, in two different environments. Let us say your company is producing tea and there is a division which is located in Assam, and there is one more division which is located in Tamil Nadu. Both the places tea is produced. But Assam and Tamil Nadu, do you think the business environment is same? Do you think the tea workers of, let us say, Assam and the tea workers of, let us say, Tamil Nadu will be working in same business conditions and their productivity will be same? Do you think it will be like that?
No, sir.
No. So in that case, if you try to compare those two divisions, then it may not give us the right result. And again, they may not be functioning on same logic. Let's say there is one more division who is focusing on some other thing, not on profit. Let's say there is a division which is focusing on charity or some other objective. Then if you compare the result of that division with another center which is focusing on profit, then you can say they are actually not mutually comparable. So it will not give us the proper result. There is one more limitation. Again, one more issue comes when this kind of comparisons are made. Many times it is taken as a fault finding exercise. That means it gives a feeling that as if the organization is trying to find out faults. So in this process, the real importance is lost. So since a department knows that his fault will be found out, it may not cooperate. So in this process, the real importance will be lost. So that aspect needs to be taken care of. And it gives limited results because it doesn't provide, and if you go for interfirm comparison, it doesn't provide exposure to industry trends. Only within the firms we are comparing. So what is the best practices working around industry? Those things are not addressed. So that is the problem. with this interfirm when you do interfirm comparison. Similarly, problems are also there with intrafirm comparison. Okay, interfirm comparison is that, as you know, the top management may feel that secrecy will be lost, so they may not cooperate. Middle management may think, or they may not be convinced with the utility of such comparison. Then one more limitation is that absence of suitable cost accounting system. If that is not there, then the figures are not comparable. Because two units or two firms are following different costing system, then the end results are actually not comparable. And suitable basis for comparison also may not be available. That is also possible because industry standard may not be consistent. Then on what basis you will be comparing? Those issues will be there. Okay, so we got a fair idea about these limitations of comparisons also. Now, if you talk about what is the relationship between interfirm and interfirm comparison, you have seen objective is more or less same. We want to find out the strength points. We want to as well as find out the weaknesses. Okay, and on both type of comparisons, be it interfirm or intrafirm, they cover the financial positions and operating results. That means they cover the figures which are appearing in the statement of profit and loss, as well as the figures which are appearing in the balance sheet. And both this type of comparisons target measuring performance of the organization against some benchmark. Benchmark might be industry, might be your past result, might be some other division. So with reference to the benchmark, and this efficiency of a particular unit is compared. So this is the relationship between these two. Okay, primarily, we have seen broadly, we have discussed about these things. But even if at this stage, if you ask you what is the reason why you are doing this kind of comparison, you may say the basic reason may be do a kind of spot analysis. That is, the strengths can be identified, strengths of the firm or strengths of the department. Problems can be identified. Okay, let us say some areas like wastages, maybe high inventory, maybe let us say poor, let's say bad size of bad debt. So these kind of problems may be addressed. One can also find out opportunity, in which areas there is a scope for improvement. Right. And what are the threats available? Okay, what are the threats available to this entity? By comparing it with the external environment, we can also find it. So this is what this may be called as the ultimate intention why you are doing this thing. Now here, as you know, through this process, one can know many things. Like this, one thing is that we can use some internal data. We can use, let us say, like costing data, etc., which will be a little difficult to find out. And it's also possible to manage or do this kind of comparison by using some data which is publicly available externally. Okay, so let me show you some comparison. Just an example, just I'm sharing a screen with you right now. Now you see, let us say, yeah, this is the data which is collected from market. Okay, as you can see, for a particular industry, you can see. Now all these data are available in the publicly available places. One thing is that you can find out the annual report, you can calculate it, but these data is collected from the websites of stock exchanges. This is collected from Mumbai Stock Exchange. You see, this is the data for TFL Limited. This is for Godrej Property. This is for Oberoi Realty. So these are the companies who are in one type of industry, that they are in the real estate sector. Okay, so we can easily compare by comparing, let us say their earning per share can be compared. And their cash earning plus share can be compared. Price earning ratio can be compared. Price to book value ratio can be compared. Return or equity can be compared. The turnover can be compared. Operating margin can be compared. Net operating margin can be compared. The market capitalization can also be compared. Free flow market capitalization can be compared. So all these things, if you collect data, you can compare. You can find out the size, that which company, what goes wrong. You can easily find it out. Okay, understood. There are many areas like this. Now I'll be asking you. Okay, one more thing. Let me show you. Then I'll be asking you that what are the areas you would like to compare. This is what I showed. So how that can be compared? This the data is available, and you can find out some other company. Let's say their audited financial statements may be available. Let's say their balance sheet, profit and loss statements. All these things can be available. So one can compare this where things are going wrong in between. After this, you see these are the industry. These are the company-wise figures. Yes or no? One can find out what is the average earning per share. What is the average cash earning per share? What is the average PE ratio? What is the price to book profit ratio? So one can average it. Then one can compare it with some other company. And through that process, one can find out what is the strengths and what is the weaknesses of a particular company. Now, I'll be asking you, and you have to tell me, identify some factors which you feel which is to be compared, and what is the use of that comparison. Okay, anybody can participate. Please tell me.
Sir, we can compare debtor turnover ratio
Okay,
so that
now
we
let
will
us say
able to-
one by one. So let us say when you are doing a comparison, let us say Interfirm we are talking about, we can compare a debtor turnover ratio. That means what is the size of debtor with reference to the turnover. What will the use? If we do it, please explain what is coming.
Sir, it will help us know the risk we are undertaking.
Very good. So you can find out if your debtor size is more in comparison to industry. That means you are taking more credit risk. There is a default risk. There is a possibility of default also. You have to investigate what is the quality of default. What is the quality of your debtors? Is it not? Okay, you can also historically see how old these debtors are. It's a more than 3 months old, more than 6 months old, more than that. Also another analysis you can do. Okay, so let us say you can break it that 50% of the debtors are more than 6 months old. You can compare it with some other company. What percentage of the debt is more than 6 months old? That means something is wrong in your debtors follow. Why it is like this? So through this process, you'll be able to identify where it is the problem. You can find out that within how many days normally data is collected. Okay, you can find out what is the industry normal credit fee. And if it is beyond that, there is something wrong with the credit management. Company's operating aspect is done well, but this credit management is poor. You have to address that issue. Like this, some other points can anyone suggest? Anybody can suggest.
Sir, current ratio.
Current ratio. That will tell us that what should be industry standard.
Liquidity position of the company. If the an ideal current ratio is yes, sir, 2:1, and a ratio below 1:1, where current assets are lower than the current liability, is dangerous for the company.
Okay, so let us not ask this is as a professional or prospective professional, we will not fix it that whether it is 2:1 or something like this. It depends upon the type of industry, right? But one thing is we'll find out what is the industry norms of current ratio. Then we'll decide whether my current ratio is poor or good. Okay, if you're having more current asset, that means more working capital is blocked. That's also a negative sign. So it will adversely affect our return on equity. My earning will be less. Why? Because working capital as such does not give any direct return. So that is the amount which is blocked for the day-to-day operation of the business. So more current asset is also a problem. But less current asset is another problem. That will create a bottleneck in the process. So what is the ideal current ratio? First we will identify whatever may be in the industry. On that basis, we'll decide whether my current ratio is according to the industry norms or not. Thank you. Now, next comparison.
Sir, asset turnover ratio.
Turnover ratio. Okay. We can compare that.
Yes.
Turnover ratio means what you exactly want to compare. You want to compare the volume.
Assets efficiency.
Okay. So you want to compare turnover with investment. Let's say investment turnover ratio we're talking. If this is the investment, what should be the turnover? That will give you some idea whether you have over-invested or under-invested. See that? Whether your turnover is according to your investment or not. Then you can take suitable investment decisions on that basis. What else we can compare? Can anybody tell something else?
The debt to equity.
Debt to equity. Okay, debt to equity ratio. That's also one more important comparison. So that will
Credit turnover ratio.
Yeah, debt to equity.
Creditors turnover.
Yeah, 1 second. First, let us address this debt to equity ratio. That will give us idea that whether my capital structure is okay or not. The poor capital structure may affect the efficiency of the firm. So that can be addressed by comparing debt to equity ratio. Okay, next comparison, what you have said.
Sir, ROC, return on capital employed.
Okay, so you're talking about return on capital employed. So you can compare the profitability with the capital. And you can see if this profitability is par with the industry norms or not. If it is poor, then there is something wrong. We need to find out the weakness. If there is par or more, that means you definitely have some strength. You need to identify and you need to maintain that strength. Right? Then what else?
Creditors turnover.
Current assets to fixed assets ratio, so that we are utilizing our funds in an aggressive way or in a conservative way. We can know that.
Okay, so my friend is suggesting that I can compare this current asset and net non-current assets ratio. Okay, so that's also a good comparison. You can find out where monies are invested, where the monies are applied. Right. So normally in industry terms, current assets gives me less return, but that is required to maintain liquidity. But non-current asset gives me more return. Okay. But that affects liquidity, adversely affects the liquidity. So this current asset to non-current asset ratio, whether according to industry standard or not, one need to compare that thing. Yes, friends.
Creditors turnover ratio.
Creditors turnover ratio. So you're talking about for a turnover, for a kind of turnover, what should be the creditors ratio? Okay, that's also helpful us. That is also helpful us that whether we are using our credit capability or not. Okay, or if
Work in progress.
Work
in progress turnover ratio.
Work in progress turnover ratio. Okay, you can say something like inventory turnover ratio also. That means for that much inventory, how much is your for a given size of turnover, where inventory is more or less. And work in progress will consider it as a part of your inventory. Okay, so as you know, inventory may consist of raw material, work in progress, finished goods, all of them. And if specifically if you want to calculate what is the work in progress ratio with relation to turnover, that will give you an indication that how long you are taking to complete a particular production or complete a particular project. Okay, if it is extremely high, that shows that your production process is too long. Why so much of work in progress? It can be either finished goods or raw material. Is it not? So that problem also can be addressed by comparing this work in progress to turnover ratio. Okay. Then what else?
So cash flow statement.
Okay. So if this cash flow statement also, it is a publicly available document. There you can find out activity-wise cash flow, investment activity, then your
Operating.
operating activities, investment activities, and financing activities. So that you can understand, okay, that company is making profit, but its cash flows are coming, is it coming from operating activities? Who knows? It might be having good cash flow, but it might be coming from some other activity. We need to compare the operating results for operating results. I see now. So by analyzing the cash flow, we can find out, okay, how much of cash flow is coming from non-operating activities. And for comparing operating result, I need to eliminate that thing, eliminate the non-operating things. Only operating results needs to be compared. So in that context, analyzing cash flow is important for us. Okay, friends. Then what else you feel?
Sir, leverages.
Leverages, okay. When you're talking about various kinds of leverages, in this process, we'll be able to find out which firm is more risky. Okay, in the process, what are the leverages we're talking about? Let us say we're talking about operating leverage. If we talk about operating leverage, what exactly we are finding out, what is the ratio of your fixed operating expenses, like depreciation, rent, etc. And if you're comparing a financial leverage, it talks about what is the ratio of your financing cost. Is it not? So that's also a fixed element. So in this, what happens if a firm is having more fixed cost? That means it's taking more risk. Return will be more and risk will be more. So this inter-firm comparison of leverages helps us that which firm is taking more risk. And if at all it has taken more risk, then ideally it should also give me ideal return. If more risk but less return, that is not desirable. Is it not? So that aspect also can be analyzed by comparing the levers. Per unit of risk, how much return one firm is giving. Okay. So if good leverage is there, that is good. Then profitability should also be that high. Understood? Anything else?
So reserve and surplus, can we compare?
Yes, reserve and surplus. Again, you can compare. If you compare reserve and surplus, what message you'll be getting? Reserve and surplus are just like shock absorbers. So if there is some loss, your reserve and supply can absorb that. Company can continue by absorbing that. So if your reserve and surplus size is good, more reserve and surplus are there, then you got capacity to absorb that much of shock. And if the company cannot absorb shock, that let's say there is a huge loss, company cannot affect, then company might have to be closed. So good reserve surplus is there is less chance of company becoming insolvent, becoming closed. Right. Poor reserve surplus may even affect the going concern assumption of an entity. Entity may not be continued as a going concern because poor reserve and surplus. If there is a loss, entire capital may be eroded. Okay, if capital is eroded, how will you be able to settle your liability? You may not be able to do it. So you might have to close your business. So therefore, reserve and surplus needs to be compared. Okay, I think friends, you participated fairly. Most of the areas you identified. And I also feel that you have understood that the topic will be useful to you also. Is it not? If you have any query, yes, Nikita, if you have any query, please ask your query.
Sir, how will it affect the cost of equity, cost of debt? How we will compare
How you will compare the cost of equity and cost of debt? You have to find out
and the
the
overall weighted average cost of capital.
yes. So in that case, you have to, let us say you are making an interfirm comparison. You need to find out what is the cost of debt, what is the cost of equity of the company. Cost of debt you can easily find out because debt is there in the capital structure, and financing cost component wise also you can find it out. Okay, in the company's financial statement, finance costs are disclosed clearly. You can find out what is the cost. But finding out cost of equity is a challenge. That you have to find it out by using some mechanism. Okay, most of the cases it will be a little difficult for you to find out, but I think you'll be able to. You have already studied, I think, how to calculate cost of equity. Because why I am saying it will be difficult? Because most of the cases, company may not be paying dividend. So that one model we use the dividend capitalization model, which is convenient model because for which data is readily available. You can calculate what is the cost of equity. Okay, if that is not there, then you have to use some other model like capital asset pricing model. In that case, you have to calculate the risk, market return, all these things. Okay, and the market sensitivity beta has to be calculated. On that basis, you'll be calculating cost of equity. So for each firm, you can calculate cost of debt, cost of equity, and by assigning appropriate weightage, you can calculate weighted average cost of capital. Okay, so in this process, you can calculate. Is it clear to you? Is it up to this?
Yes, sir. Thank you.
Thank you very, very much.